In today's energy landscape, multi-agent systems, MAS, are transforming renewable and storage asset management by enabling more precise strategic decisions and optimizing complex operations. Their approach focuses on distributed intelligence, enabling a holistic and proactive view. This facilitates agile and informed decision-making, essential for success in this sector. The era of static spreadsheets and manual reporting is coming to an end. Renewable energy portfolio management requires a technological evolution. SMAs provide a robust platform for real-time decision-making. These systems offer deep insights into markets and assets, overcoming the limitations of traditional methods thanks to their ability to process large volumes of data. With deep insight into markets and assets, these systems outperform traditional methods when processing large volumes of data. Excel reports lack interactivity and depth, making clear communication with investors and banks difficult. Static information can lead to misinterpretation. Spreadsheets don't manage real-time data or integrate multiple sources or complex simulations, creating a fragmented and outdated view of assets. The lack of agility makes it difficult to communicate effectively with stakeholders. Static data doesn't reflect market volatility or opportunities. A smarter, more scalable solution is needed. Excel is insufficient for the current demands of the energy sector. A more advanced tool is essential for efficient and profitable management. Multi-agent intelligence offers this comprehensive and scalable solution. Multi-agent systems generate key advanced metrics to understand asset performance and make sound strategic decisions. Their value lies in their ability to offer a multi-dimensional view. They allow risks and opportunities to be assessed with unprecedented precision. This is vital for optimizing investment profitability and sustainability. The metrics generated by SMA are categorized into specific areas. This allows for detailed analysis of each portfolio component. The granularity of information is critical for effective management. The levelized cost of energy, or LCOE, is a fundamental metric. It evaluates the total cost of building and operating a photovoltaic plant. SMAs calculate the LCOE with high accuracy, considering multiple variables. The performance ratio, or PR, measures the actual efficiency of a PV plant. It compares actual output with expected theoretical output. A high PR indicates optimal performance and sound operational management. The P50 and P90 production probabilities are essential for risk assessment. P50 represents expected production with a 50% probability of being exceeded. P90 indicates production with a 90% probability of being exceeded, reflecting a more conservative scenario. The difference between P50 and P90 is a key indicator of uncertainty. A wide gap suggests greater risk in production projections. SMAs model these probabilities in great detail. Levelized cost of storage, or LCOS, is vital for BS. It quantifies the cost per unit of energy stored and discharged. SMAs optimize LCOS by considering the battery's life cycle. Revenue stacking potential is a key advantage of BESS. It allows for the monetization of multiple services, such as arbitrage and frequency regulation. SMAs identify optimal strategies to maximize these revenues. The impact of cycle degradation is a critical factor for BESSes. A battery's lifespan decreases with each charge and discharge cycle. SMAs model this degradation to project long-term performance. Understanding degradation is crucial to the cost-effectiveness of BESSes. Accelerated degradation can significantly impact LCOS. SMAs provide early warnings of deviations in degradation. Value at risk, or VAR, quantifies the maximum expected loss of a portfolio. It is calculated with a specific confidence level and over a given time horizon. SMAs provide an accurate VAR for the entire portfolio. The regulatory risk score assesses the portfolio's exposure to regulatory changes. Energy policies can significantly impact project profitability. A high score indicates greater vulnerability to regulatory uncertainty. Market exposure, or merchant exposure, measures the dependence of revenue on the spot market. High exposure implies greater volatility and risk. SMAs calculate this indicator to optimize hedging strategies. These combined metrics provide a comprehensive view of risk and return. They allow investors to make informed decisions about capital allocation. Proactive portfolio management is critical to success. Advanced metrics are derived from the cross-referencing of multiple data sources. Technical, historical, market, and regulatory data are integrated in real time. This correlation capability is a distinct advantage of SMAs. SMAs transform complex data into actionable information. This enables managers to make strategic decisions with confidence. The speed and accuracy of the analysis are unparalleled. Metrics guide critical decisions, such as the choice between PPAs and merchant strategies. A PPA offers revenue stability, while the spot market can generate higher returns. SMAs assess the optimal balance for each project. They also inform battery investment, optimizing their size and operation. The decision to integrate BESS is based on a detailed analysis of its profitability. SMAs provide the necessary economic justification. These metrics are essential for defending financial models to banks. They provide the transparency and robustness required for project financing. Lenders' trust is built on robust data. Monte Carlo simulations are a powerful tool in SMAs. They allow for modeling uncertainty and risk in energy projects. Their application is essential for a rigorous financial evaluation. This methodology generates thousands of possible scenarios, reflecting market volatility. It provides a distribution of outcomes, not just a single value. This is crucial for understanding the range of possible returns. The simulation process begins with defining the inputs. Technical asset data, such as PV production and battery degradation, are included. Contract terms and current regulations are also incorporated. Future energy price forecasts are a critical input. SMAs use advanced models to project price developments. This allows them to simulate the impact of market volatility. Once the inputs are defined, the SMA runs thousands of market scenarios. It uses Monte Carlo models to generate probability distributions. Each scenario represents a unique combination of uncertain variables. This process is automated and performed at high speed. The computing power of the SMA is key to this efficiency. Robust results are obtained in a matter of seconds. One of the main outputs is the internal rate of return, or IRR, under different scenarios. The IRR is calculated for P50, P90, and the worst-case scenario. This provides a complete view of risk and return potential. SMAs also project investment payback periods. This is vital for financial planning and liquidity assessment. It allows investors to understand when they will recover their capital. Value at risk, or VAR, is another crucial outcome of simulations. It quantifies the maximum potential loss of the investment. VAR is a standard metric in financial risk management. Speed and efficiency are distinctive benefits of SMAs. Results are obtained in seconds, as opposed to the weeks or months required by Excel. This agility enables much faster decision-making. The ability to run thousands of simulations in a short time is transformative. It allows for the exploration of a much broader scenario space. This reduces uncertainty and improves decision quality. SMAs not only calculate metrics, but also identify potential risks. Their predictive analytics capabilities are critical for proactive management. They provide early warnings that traditional tools cannot. This function is vital for protecting investment profitability. It allows managers to anticipate problems before they materialize. Early risk detection is a key differentiator. A common threat is overestimation of PV production. A large gap between P50 and P90 indicates excessive optimism in projections. SMAs warn against this difference, which can affect the IRR. Another threat is optimistic revenue projections for batteries. A high actual LCOS due to accelerated degradation can reduce profitability. SMAs monitor degradation and adjust projections. Excessive exposure to the spot market, or a high merchant exposure score, is a significant risk. Price volatility can negatively impact revenues. SMAs identify this vulnerability and suggest hedging strategies. Critical regulatory changes, reflected in a high regulatory risk score, are also a threat. Changes in policies or tariffs can drastically alter a project's viability. SMAs monitor the regulatory environment and alert on potential impacts. These threats, if not detected in time, can penalize profitability. SMAs provide the visibility needed to mitigate these risks. Their multidimensional analysis capabilities are key. SMAs provide early warnings that Excel or static reports cannot. Their continuous monitoring and predictive analysis are unparalleled. This capability is an essential safety net for investors. These alerts allow managers to react and mitigate risks in a timely manner. Hedging strategies can be implemented, contracts renegotiated, or operations adjusted. Proactivity is essential to protecting value. The ability to anticipate problems is an invaluable asset. It allows organizations to maintain financial and operational stability. SMAs transform risk management from reactive to proactive. Real-time information and automatic alerts are crucial. They ensure decisions are made with the most up-to-date information. This minimizes surprises and protects investments. SMAs not only generate data, but also transform it into solid arguments. They facilitate effective communication with investors, banks, and regulators. They provide the basis for defensible and transparent decisions. Clarity and precision of information are essential. SMAs allow complex scenarios to be presented in an understandable manner. This builds confidence and reduces uncertainty. SMAs make it possible to clearly explain the potential gains and losses of a project. Monte Carlo simulations offer a range of outcomes. This provides a realistic view of risk and return. They also clarify investment recovery periods. Projected cash flows and payback periods are presented transparently. This is essential for financial planning and liquidity assessment. The impact of market and regulatory changes is detailed. Sensitivity analyses show how variations affect profitability. This allows stakeholders to understand the risk factors. The presentation of these metrics is visually intuitive and easy to understand. Interactive dashboards allow for in-depth data exploration, facilitating dialogue and collaborative decision-making. The robustness of the data generated by SMA is undeniable. They provide an empirical basis for all discussions, elevating strategic conversations. The ability to present defensible information builds trust. Investors, banks, and regulators value transparency and rigor. SMAs provide the evidence needed to support decisions. Decisions are based on solid information, not intuition or assumptions. This reduces the risk of costly errors and improves investment quality. Data objectivity is paramount. Minimizing surprises is a key benefit of SMAs. Early warnings and thorough simulations anticipate potential problems. This allows stakeholders to be prepared for any eventuality. Proactive, data-driven communication strengthens relationships. It demonstrates a commitment to risk management and performance optimization. This is crucial for attracting and retaining capital. Trust is built on transparency and responsiveness. SMAs provide the tools to achieve both goals. They are a strategic asset for any organization. In this video, we explored how multi-agent systems transform decision-making. Their ability to generate advanced metrics overcomes the limitations of traditional tools. Multi-agent intelligence is the future of energy asset management. These systems are not just an improvement, but a revolution in data analysis. They provide an unparalleled competitive advantage. Investing in SMA is an investment in the future of profitability. The key lies in having the right data and processing it with specialized artificial intelligence. SMAs not only automate, but also interpret and contextualize information. This is something Excel simply cannot do. An SMA thinks alongside the user, revealing insights that spreadsheets hide. It identifies patterns, correlations, and risks that would otherwise go unnoticed. Its analytical capacity is far superior. Processing speed is crucial in volatile markets. SMAs provide real-time information, enabling rapid reactions. This is crucial for capitalizing on opportunities and mitigating risks. The quality of the data and the sophistication of the analysis are unparalleled. SMAs ensure that decisions are based on the most accurate and relevant information. This is a key differentiator in the industry. SMAs don't simply automate calculations. They provide deeper insights. They transform assumptions into informed and defensible decisions. This is vital for investor confidence. Leveraging multi-agent intelligence is essential for investment, scalability, and portfolio presentations. It enables performance optimization and proactive risk management. It is an indispensable tool for success. The ability to model complex scenarios and quantify risk is transformative. It enables organizations to make strategic decisions with confidence. SMAs are the ideal partner for energy portfolio management. In an increasingly complex and volatile world, multi-agent intelligence is key. It provides the clarity and insight needed to navigate the future. It is the path to superior decision-making and sustained profitability.